Good evening. I'm Luke Ward. I'm one of the 3 deputy managers from Baillie Gifford who manage the Edinburgh Worldwide Investment Trust. And I'll move on to talking about the trust in a moment. But first of all, I just wanted to talk about the environment we're operating in today and why it's often important to ignore it completely. If you want to read more of these disclaimers, we've got handouts at our desk later on. So if you turn on the TV, you're often confronted with something that looks a little bit like this. We live in an age of 24-hour breaking news. Often something very important is happening, it's often negative, and we're compelled to take some sort of action. Now, this is an intrinsic thing for us to do. We want to add some sort of certainty to what is an uncertain world. In the investment scope, this shows up as trading or shuffling around portfolios. But despite this call to action, at Baillie Gifford, we think it's very important to focus on the long term, and here's why. Over the long term, share price performance is driven by company fundamentals. And by this, we mean sales growth, we mean earnings growth, and we mean growth in cash flows. It's only when you look at the data behind this trend that you see just how profound that link is. So this chart plots a quarter of a century worth of equity market data from around the world. In the blue bars, you can see the market split up into quintiles of earnings growth. That cohort which generated the highest levels of earnings growth is on the right-hand side, and the one with the lowest growth is on the left-hand side. The line in blue is the equivalent plot for the share price returns of those cohorts. Now, what you can see is that the company which delivered the highest earnings growth rate also returned the highest share price performance. Those with the lowest earnings growth rate returned the lowest share price performance. So for those with a long-term horizon, we think this means taking a very optimistic view of the world and focusing again on those company fundamentals. So what drives company fundamentals in the long term? Well, when we're thinking on a 5-year, a 10-year plus basis, it's quite often, as others have pointed out, technology which becomes a big part of that. Often on a year-to-year basis, it's hard to appreciate just how far we're coming. But if you take a step back and think where we were 10 years ago, the rate of progress which we've made has been nothing short of incredible. So take connectivity as one example. 10 years ago, there were about 10% of the population who had access to a smartphone in the UK. Today, that stands at 80%. Imagine trying to live your life today without all the services we've come to enjoy, which are provided by these smartphones. Think of Uber, think of Airbnb, think of Google, Facebook, Netflix. All have been made possible, and their big growth opportunities have made possible thanks to these small devices. There's one thing which I find particularly striking about this as well, is we're just at the beginning of these kind of trends. 90% of all of the world's data was created in just the last 2 years alone. That's a staggering figure when you think about how far we've come, but it's only set to get stronger. Another one which I'd point out is genomic sequencing. We've heard that mentioned before with Agilent. 10 years ago, it cost $10 million to sequence just one human genome. Today, that cost is under $1,000. As a function of that, scientists have been able to learn far much more about the human body than we thought possible. So when the Human Genome Project began, there were around about 60 diseases which we thought had a genetic component, whereas today we know that number stands closer to 6,000. Those are just one or two of the technological advances which we've seen, but I think the most pertinent message I want to convey is that these technologies don't exist in isolation. Each one of them builds on the one which has come before it, and also bounces off the ones that are next to it too. So the rate of progress which you're seeing here is actually accelerating. Now for businesses, this means that the toolkit they have, both to grow and to solve large problems, is increasing as well. And this is what really excites us. So maybe if we have a little look at one of the companies we've invested in recently for the Edinburgh Worldwide Trust, we can give you an example of this. This tinfoil monstrosity is a weather satellite. And at 5 tons, it's probably one of the most complex and difficult things that we humans can create. The costs are quite literally astronomical as well. This one in particular costs about $4 billion over its entire lifetime. So as a function of that, it's remained the preserve of big governments or big aerospace companies. They've been the only ones who've been able to produce this kind of innovation. But thanks to the progress we've had in the toolkit, that's now changing as well. This is also a weather satellite, and it's made by one of the companies we invest in called Spire Global. Now, whilst it might not look that impressive on its own, it's actually part of a constellation of over 100 units that are able to survey the world in great detail and at a significantly reduced cost to that one we saw on the previous slide. So what does that mean? Well, this is only possible because we can buy smartphone components, we can take them off the shelf, and we can put them in these satellites. The investments that have been made in renewable technologies translate to more efficient solar cells for them. And the capacity for Amazon and Google to process data at scale means that a small company from Glasgow can outsource all of its computing capability to the cloud, so they can do intense analysis and storage of this data without having to invest in any of the capabilities themselves. Now, the idea that a satellite company like this can challenge the Met Office in terms of the accuracy it can deliver is quite striking. But as an example of the acceleration we're seeing in technology, it only takes them 2 weeks to manufacture one of these satellites, and you can launch them in bulk every month. So if they come up with a new innovation or a new sensor they want to include on the satellite, it's relatively trivial just to bolt it onto the side. So one example of this, which they're implementing right now, is a worldwide airline tracking service. So those of you can recall that we're still trying to look for the Malaysian Airlines plane which went down. At the end of this year, it's going to be mandatory for every single aircraft to transmit a signal, which is only going to be able to be picked up by these satellites and those of one other competitor. It is trivial for them to introduce this, and there's many more ideas which they have along the way. Things like surveying plots of land for agriculture, getting involved in transmitting SOS signals, tracking assets that companies own as they move around the globe. All of these are going to build on top of the main innovation, which is this smaller satellite. It's when we see these kind of opportunities that we get really excited in the trust. We're trying to own the young, innovative companies of today that have the potential to become the big winners of tomorrow. And when we find these companies, we want to retain our ownership in them. We're not going to be forced sellers just because they eclipse some sort of market cap limit or because they have volatile prices in the meantime. And there's a very good reason for this. The opportunities that a portfolio like this provides is highly asymmetrical in nature. So I promise you this is the last chart I'm going to show you today. But this plots the historic individual return of each of the companies which we've held in the portfolio. Now, what you'll notice from the far right-hand side here is that it's implicit with owning a selection of companies like this that some of them aren't going to work out. We're not going to get all of these investments right. And as a function of that, there's a potential to lose all of our money in individual companies. But what rationalizes us taking this approach is what happens on the left-hand side of the chart. Because these companies are out here trying to solve big problems, they have the potential of making big rewards as well. If a company does well, it can make many times its initial investment. And as you can see on the chart here, it can more than pay for those which don't work out. This is the engine house of the portfolio. This is what really drives the returns. So that's a bit of the philosophy behind how we go about investing. I'm just going to take some time now to talk about the process which we follow. What is it we look for in these companies before we put them in the portfolio? Now, the first thing to remember when it comes to small cap investing is there's a dirty secret to it. Most smaller companies aren't that interesting, and they don't have the potential to become large businesses. They're constrained either by geography, they have to invest in distribution, or they're in sectors which are fairly commoditized. Think of your utilities, your banks, your home builders. There's only a limited problem which they can address. We're trying to find the very small subset of the universe which are out there solving genuinely big problems. And that's because they have genuinely big growth opportunities. Typically, these are the innovators out to create a brand new market, or they're the disruptors out to revolutionize an existing one. Some examples from our portfolio right now would be Tesla, which is out to make the internal combustion engine redundant, or Ocado, which is out to change the way which we buy and distribute groceries online. Those of you familiar with Baillie Gifford from other portfolios will know that we place a lot of emphasis on competitive advantage. Now, Edinburgh Worldwide is no different in this regard, but the slight nuance is that we're thinking about what competitive advantages are going to look like in 5 years' time, in 10 years' time. These formative companies often don't have very many tangible signs today that they have an edge over the competition, other than they're doing something unique, or they have a limited set of direct peers. As a function of this, there's often a lot of uncertainty in them. There's a lot of delayed gratification required in holding these companies. And we think it's one reason why the market tends to shun this approach, and often means that a lot of these companies are underappreciated. The next facet of these companies which we look at is management. Now, management are very important in a company, both for shaping the vision and how they go about operating the business. This is particularly true in younger companies and the formative ones which we're looking at. So what we want here are people who are aligned with our time horizon. We want people who recognize the long-term opportunities that the business have, and they're investing behind those opportunities. We don't want people who are paying too much attention to quarterly results or how they're perceived in the media. Many of you will probably be familiar with Elon Musk from the press in this regard. Love him or loathe him, we think he's quite a strong visionary. But there are other examples within our portfolio. Around about 2/3 of the companies we own still have a founder in place, either as the CEO or on the board. And they're very key to shaping these companies. Perhaps one to focus on is Rick Stollmeyer, who's up here on the left-hand side. Rick Stollmeyer is a retired Navy captain. And about 18 years ago, he decided that he wanted to start a business out of his garage in California. Today, that business is worth $2 billion. Now, for most people, if they'd been able to create a business like that, they'd be on the next plane out to the Caribbean with a big briefcase full of cash out to live out their days. But Rick Stollmeyer is not doing that. And why is that? Well, he sees what this business could become in the next 10 years. He's very much excited about where that potential it has to run. And he's sticking with the business because he believes there is a genuine long-term opportunity there. This is the kind of thing which we look for. We want to be co-owners of businesses with these kind of people and align ourselves with their kind of intrinsic motivation. The fourth thing is scalability. Now, what do we mean by scalability? Well, this is the ability for businesses to grow whilst maintaining or improving their returns. Now, usually that's a difficult thing to do. If a company is located within a particular geography exclusively, or it has to invest in customer service, it has to invest in distribution, the incremental cost to grow your business could be quite high. And this speaks to why quite a lot of small businesses struggle to become larger enterprises. Where we get excited is when we find businesses which have these kind of characteristics. Many of you will be familiar with network effects from the way that Facebook was able to rise to dominance in social media, or how if anyone has a question these days, we're straight onto Google to find the answer. Well, we think these advantages apply much more broadly than in the large caps. So for example, one of the businesses we own is a company called Market Access. Now, they run a bond trading platform. Traditionally, bonds have been traded over the telephone. And this is the one which is bringing innovation such that it can be done on a computer. Now, when the liquidity pool gets deep enough, it becomes the go-to place for new customers to bring their business. Each incremental consumer makes a superior transaction for the next. So market access barely has to invest in customer acquisition, and what they find is an actual increasing return as they grow their business. Another one which I'd like to highlight is this idea of platform technologies. A platform technology is something which is based around a core concept or a core piece of intellectual property, but it actually has applicability in a much broader sense. So we invest in a company called Alnylam Pharmaceuticals, and they have a genetic silencing capability. So they can create drugs which go in and they turn off individual genes or the expression of those individual genes. Now, originally, this was just focused at one rare disease case, but it's the nature of the mechanism which they have which allows them to target many more. So once they've proved efficacy in this one indication, it increases their chances and abilities to go out and solve more and more diseases. So when we bring all this together into the portfolio, it looks something like this. So from the bottom up, we've selected around about 90 stocks. Our aspiration is to hold them for the very long term. You'll see from our turnover stat, we're about 10% turnover each year. So that translates to a 10-year average holding period. So we are genuinely long-term in this approach. Most of the businesses you'll find aren't really that well known at present. There's one reason why I've highlighted the industries they're operating in rather than giving out the names. But over time, we'd like to think that these are going to become the household names of the future. They're all fast growing, and they're all involved in industries where we think there's going to be profound change over the long time. We aren't afraid to go early in this search. About a third of the companies in the portfolio are pre-profitability at the moment. We also aren't afraid to run our winners, and unlike many other funds, we don't have any caps on how big these companies can get. One of our aspirations would be that over the long term, if we do this right, Edinburgh Worldwide could very much start to become an all-cap portfolio with a handful of big winners, but with the idea generation very much focused on that earlier stage business. So these are the top 10 holdings in the trust. Hopefully you recognize one or two of these if we're doing our jobs well. I've mentioned a few of them just in my previous talk there. It's often challenging but quite rewarding to invest on this basis. And we're only able to be long-term because Edinburgh Worldwide has a shareholder base which appreciates this philosophy, places its trust in us, and the process which we have of finding these companies. So with that, I'd like to thank you for your time today, and please do come and speak to us later if you'd like to know more. Thank you.